you know, a recurrent theme throughout the day has been the importance of integration and cross-border. And of course, we can't get effective integration without finance cross-border. And so really understanding how regional finance is happening and when it's not happening, why it's not happening, the constraints is really important if we're going to solve the integration issue. And we've also talked about the importance of agribusiness. When we spoke, heard our heads of state, they talked about the importance of value-added processing on the local level. In some of the work we've done with agribusiness in Africa, it has been extraordinarily hard to get deals done. And part of it relates to how you can, I think Mark Powell from PricewaterhouseCoopers was talking about the difficulties of contractual obligations and dealing with performance risk. It becomes very difficult when you have supply chains, farmer organizations, offtake agreements with different companies, and how you solve that operational issue. So we have very important critical issues if we're going to really deliver on the SDGs with regards to these two issues. So I'm very happy to be able to try to bring forward our experts here and ask them questions. We're going to start with Mimi Nedeljkovic. How do you say it?
Nedeljkovic.
Oh, thank you. President and CEO of the Initiative for Global Development. And Mimi, my question for you is, Africa's agribusiness sector is not only your passion, but also your past occupation. Can you tell us from a private sector operator and an investor's viewpoint how you would think through the missed agribusiness opportunities on the continent and what we really need to do to be able to crowd in and scale up the private sector?
Thank you very much. Good afternoon. Very quickly, I'll speak more from my background. The last 25 years as an agro-industrial developer, mainly in sugarcane, rice processing. I run now this past year the Initiative for Global Development, which is a group of business executives worldwide that are focused on their investments in Africa. But on the ag side, and really does fit into the whole integration side, I think the major driving factors are issues that have been raised before. The large population growth. I mean, we're going to surpass 2 billion. The urbanization, over 50%. You have, with that demand side, the potential of, facts been quoted before, you know, over 50% of the arable land in the world still is in Africa, and less than 10% of the water is any which way used. So I think what we're seeing is that possibility basically of the demand for the food, the demand for the value addition. I think that's really where the investment side is very interesting, because as you're having over half the people living in urban areas, you're no longer going to be, people are not going back to their villages to pick up the food. You're going to the supermarket. So you have all of the packaging, the smaller containers, the value addition to the food. All of this really fits right into all of the issues with the SDGs, and that is, in fact, the growth. It is the job creation. Most of light industry, if you've seen historically, in any of the countries going through development process, is often basically the transformation food to begin with on the light industry side. Where I think if I could just touch, and I know we're short in time, on the market size, that's also critical, because you have, and I'm primarily been most involved in investments in West Africa, where other than Nigeria, that's large enough to be its own market, all of the others, there's got to be a real truth integration of the economies. It's not a question of just saying we've got, so many people in ECOWAS. The fact is right now, you really cannot easily move product across borders. And for farming, it's all about, and value adding to the farm product, it's all about catchment areas, we call it. You're going to have catchment areas for where your raw materials are coming from, in the catchment area is basically where your markets are going out. And, you know, interesting enough, and I'll stop with this point then, is that by and large, you have to irrigate, so it's a question of getting the value addition. You got to get better crops, clearly. And then the interesting part, you know, rivers tend to be the borders, right? And you're irrigating off rivers. So I've so often have been in a situation where our projects are in border areas closer to the other country than the capital of the one we're operating in. So that issue of cross-border movement of product is absolutely, absolutely critical. And if you can't scale, you can't be competitive. Where the small farmers come in is with the combination. I think it's one of the big issues that ADB is going to be focusing on, and that is bringing together the commercial ventures with the small farmers. There's not a problem with having small farmers as long as they're inside the value chains. That's the key. Then they can scale along with the factory, but the factories have to scale to be able to be productive. Thank you.
Really a very important development challenge. We've got to get our arms around. That's very helpful. Now, if we go to the other side of the agribusiness chain, and we ask Bill Egby as Group Director of the Coca-Cola Company. Bill, you're one of the continent's largest employers. So you have a wealth of knowledge that the public sector could benefit from about how to create more commercial and globally competitive agribusiness investment opportunities. So with that in mind, what do you think is required from the public and private sectors to boost agribusiness job creation and as well as access to export markets?
Thanks, Barbara. Good afternoon, everybody. I think a lot of what is needed is pretty straightforward and pretty intuitive. Based on our experience trying to integrate, you know, local or smallholder farmers into our value chain in parts of East Africa, the key thing is just the need for some kind of collaboration and coordinated action between the government and the private sector on the key things that the smallholder farmers would need, for example, to be able to plug into our value chains. And I'm talking about being able to partner on building skills on a targeted basis, very specific skills that they need to be able to raise the quality to be competitive globally. It's about specific training to enable them to drive productivity and to be more reliable suppliers to a global value chain. Those kinds of things are things which you can try to do on one side, like in the private sector, but you're more effective if you're able to get coordinated action by both the private sector and the public sector. We ran a big project in Uganda, for example, reaching 50,000 smallholder farmers. And the key to being able to raise the skill level of those farmers to be able to plug into our value chain was being able to convince the government to allow us to integrate 1,500 government officers into the training program to help us with deploying and reaching these farmers. This was a case where we brought the resources for the training, but we leveraged existing capacity within the government to help us reach the farmers. So that kind of coordinated action is quite critical, I believe. Another area where it's important for us to have coordinated action is just access to information, knowledge, and expertise. I mean, the public sector has access to this information and expertise, and sometimes I think we struggle to bring it to bear to enable some of these players in the value chain to be more effective. And in this case, I think a good example was just we were able to help the farmers again in Uganda. We found examples from India where they were practicing certain agricultural methods that were very relevant for Uganda. And we found out because we're doing similar projects in India. But I think leveraging the government's contacts, we were able to transfer not just the knowledge, but some experts to come and help in Uganda. And I think that kind of partnership helped us move much faster. So that's about coordinated action and collaboration to help us transfer knowledge, bring skills much faster. But the second part that is even more important, I think, is the ability to co-invest. I think, there's some priority areas for us to accelerate agribusiness in Africa that need some degree of co-investment to accelerate things. And I'm talking about, our experience showed that in basic elements like just storage, processing capacity, some basic logistics, to enable these local farmers to be able to plug into a global supply chain, they just lacked a few bits and pieces of infrastructure, which a private sector player that's not primarily based on building infrastructure could not do on their own. But by partnering with government, to be able to say, okay, well, storage is something which, if we put our resources together, we can help these 50,000 farmers to build the storage facilities for their mangoes so we could be able to export internationally. I think that kind of collaboration worked very well. The ability to co-invest proved very useful in this case. And the last element that I think is also quite obvious, but is critical to enable these small players to plug into the global value chain, is around just making sure that we can invest in getting the standards, the quality standards that are required to be competitive internationally are being approached. We know they will not be there day one, but I believe that in some of these examples, in South Africa, for example, making the investment to ensure that the farmers understand the quality standards, we put them on a path towards reaching those. Things like providing labs where they could test their vegetables or fruits to make sure that you could have consistent proof that you don't have pesticides in these products was basic stuff which wasn't there before. But by co-investing in these elements, we're able to plug these farmers into a global supply chain that was able to supply processing plants that were outside the African continent. So some of these basics are, they seem obvious, but until you get into the field and start working on these and find the right partners on the other side with whom you can collaborate on these, sometimes it is more difficult than you would think. They're obvious, but it requires willing parties on both sides to put their heads together and find a solution on how to create the right agreements on how to partner on these things. I believe collaboration and partnership in trying to meet some of these needs is the most fundamental need, is the most fundamental element that's required to accelerate agribusiness in Africa. And if we are able to partner with the government effectively, I think we can scale up the things that we're doing and be able to provide a more sustainable outlet for some of the capacity that we have in agriculture on the continent.
Your points resonated very deeply because we've worked with agribusiness projects in Uganda, for example, ICU, 30,000 farmers for milk processing. And before we move on to banking, I can't help but just voice that when we listened earlier to the heads of state speaking about the national and regional competitive strengths in their countries, and this is a comment and would love to hear people respond, but to me, in Monterey in 2002, we had the concept. We have the concept again in Addis. What I think we're missing is the machinery, because when you look, for example, in Uganda, if you're looking to work with local government official NADS, okay, the Agricultural Service, it is a mess. Okay, dysfunctional. If you look at the Uganda Board of Standards, they won't even go to Kayunga district to be able to help a local women's cooperative of wine be able to meet the requirements for national or exports. So there's, and I think if we think about the objective of this meeting and thinking through how do we in the private sector with our public sector colleagues really think what we need to tell heads of state, how they're going to operationalize this great need to mobilize private sector capital. We really need to take the experience of people like yourself and boil it down into operational terms so they can understand how to better manage the governmental functions in a concrete way. So with that, I shouldn't be going on. We should move now to banking. And if I could move to Rafiq Bengali, who is the General Manager of the United Bank of Africa, and ask you, Rafiq, what challenges does your institution encounter with its African expansion, and what's your view on partnerships that your institution would like to see to really address the bottlenecks that are thwarting cross-border banking and integration, and also as it relates, if it's relevant, to agribusiness? Thanks.
Well, thank you. Thank you for having me over here. I wanted to first pass on my CEO's regret that he's not here today making the presentation himself. So I'll speak from the corporate point of view. The regulatory, there aren't only just regulatory challenges, there are regulatory and economic challenges, and sometimes the two are intertwined. The regulatory bottlenecks that we face, the significant delays in obtaining licenses in the different countries, brownfield acquisitions, difficulties in obtaining brownfield acquisition. That's why longer gestation routes of organic growth need to be taken. Lack of harmonization of banking regulations, complexity of multiple jurisdiction, deficit in infrastructure when you look across different African countries. It's not, not all the same, but different countries have different stages of the infrastructure development. When you talk about if the infrastructure is not there, you have an increased cost of sourcing even power. Inadequate roads and railway links are detrimental as far as expanding your operations. Managing different time zone languages, we need to centralize for economies of scale. We have cultural differences. You need a sophisticated HCM, human capital management for employee productivity to bring them and close the knowledge gap. The ability to optimize returns is difficult. Skill shortages in the various countries, specifically if you have to fill subsidiaries with local employees. Secondment of employees is difficult across some of the borders. Absence of market structures, credit bureaus, credit history, challenges, is very challenging. Now, the next thing you look at, the economic growth, with the plunge in commodity prices has weakened fiscal revenue, and then if exchange rates devaluation that has happened, slower foreign investment coming into the country, FX receipts, fragile external reserves. Now, I'm talking about across Africa. If you look at Nigeria and Ghana, the currencies were effectively devalued. And at the same time, regulators start increasing interest rates or start increasing reserve requirement. Those are challenges that you face. You know that Nigeria monetary policy rate is 13%. Cash reserve requirement is now 31%, for 75 and 25 before, depending on what kind of deposits you had. The foreign currency borrowing that the bank were allowed to have up to 200% has been dropped to 75%. Open trading positions are cut. Even in other African markets, Ghana, the MPR is 22% plus. There's a depreciation of the cedi. In Kenya, the MPR is up to 11.5%. Though the rest of the Francophone West Africa is relatively stable, right? So it's, when you talk about partnerships and developing partnerships, it's more than just with African banking regulators, There need to be, of course, harmonization of policy, regulation, cross-border banking, but then we talk about sharing infrastructure between banks. Now, I'm not talking about infrastructure of roads and railways, but banks need to start sharing, like SWIFT is a utility that is being used by all banks around the world. you need to start building structures for, KYC, which is Know Your Customer, compliance, repository, and you might want to have a utility. So banks can start also working together in forming partnership, to overcome those challenges. Partnership with government agency, public-private partnership to address the infrastructure deficit. How do we finance infrastructure? It's very difficult under the new Basel, 2 and 3, to do long-term financing in countries outside of OECD, right? So how do we tackle that? Where do we find the partners who have the long-term money, be it insurance companies, be it people who manage pensions, we need, so there has to be a lot more partnership over there. How do we close the power gap? The shortage of power all over. When you talk about infrastructure, 1/3 of Africans are living in rural areas close to an all-seasons roads, whereas versus 2/3 in other developing nations. So you are like at half the point. So a lot has to happen over there. How can our institution play a role as far as agriculture is concerned? I think agriculture, UBA, in all the geographic areas it is, has committed to agriculture. And in Nigeria specifically, we have, if you look at a total portfolio, we have about 3% of our total portfolio investment in agriculture, and that is among the largest among the banks in the area. So the other partnerships, we do have partnership with AFDB, FXIM, AFC, Ministry of Finance, Central Bank, to move forward when you talked about the SDG initiatives, all right? And obviously, besides the bank itself, our chairman, Tony Elumelu, his foundation is very much involved in some of the other matters when it comes to the SDG goals, be it about women. I mean, SDG goals, we talk about 6 pillars.
It is good business because we're going to develop markets. So that was very helpful. Simon, now for you. So Simon Zadek is co-director of UNEP. And Simon, our question for you is, we're here in the face of the Sustainable Development Goals. They're not just the development goals. We have a new focus. And throughout the day, different speakers have highlighted the real challenges we face for the environment, as well as inclusive growth. So could you give us some thoughts about how the banking community, regulators, and maybe even agribusiness can think through this challenge? Thank you.
Thanks very much. And I know we're getting to the end of the afternoon, so I'll jog it along a little bit. So it would seem absurd to suggest that high levels of integration are a problem. But I want you to think about it. I think Mr. Bengali has quite rightly highlighted the absolute importance of many levels of integration that need to happen within the banking community, and our colleagues from the agribusiness community have also highlighted many of the integration challenges that we know about but are well worth highlighting and trying to address. But let me kind of take this from a slightly different angle. It's clear at some pace that cross-African financial and capital markets will grow, will become more sophisticated, and will become more integrated. I don't think there's any question about that at all. It's a question of time, pace, but it may also be an issue to do with how. And that's really what I wanted to touch on this afternoon. For example, it may seem strange to point to London and New York as problem examples, but we have highly sophisticated banking communities and indeed capital markets, and in both countries, extraordinary infrastructure problems. And we have financial and capital markets in the US and in the UK actually consistently failing to invest in their domestic or host economies. The Brazilian banking community and the South African banking community are 2 of the world's most sophisticated banking communities and happen to be 2 of the most profitable banking communities in the world. And yet, look at the infrastructure problems in Brazil. And look at the infrastructure problems that are beginning to emerge even in a South African context, which has certainly amongst the most sophisticated infrastructure on the African continent. That we can't simply say better banking integration, more sophisticated capital markets, and you get the right answer, because actually we know that's not true. And so the question becomes not just we should integrate, but what is it that we need to integrate? How do we need to develop financial and capital markets to ensure that they don't only get over some of the very barriers that Mr. Bengali has highlighted, but that they don't end up like London and New York, which actually simply has another set of problems that detaches the financial community from the real economy and development processes. I would ask you to think about that a little bit. Two sets of examples just to really reinforce the point. We've already heard, from my right, that Basel III is a problem. And for those of us in the banking community or working in the banking community, one can describe that in many different ways, but the kind of dead simple version is it disincentivizes less liquid long-term investment. It forces mark-to-market accounting that creates volatility on the balance sheet. And actually it was designed to solve a bunch of problems in the OECD, and it doesn't do anything to solve any problems in developing countries. In fact, quite the reverse. It creates problems that developing countries didn't have at that point. So here's an example of a level of integration that actually may be problematic for Africa, may be problematic for Latin America, which is how are international standards that are driving certain types of integration actually benefiting or not benefiting the African continent, and what voice does the African banking community have, not through international intermediaries, but a voice yourself in seeking to influence international standards in a way that it actually delivers the kind of banking standards and integration that's needed at the ground level in Africa, but also we could have a similar discussion about other parts of the world. So yes, you need integration into the international financial system, but you need integration that makes sense for you. And we know that Basel III, Solvency II, and many other things that have happened since the financial crisis actually are going to be really difficult for the development of financial and capital markets across the African continent in serving the very needs that you've been discussing throughout the day. Integration, interesting question. How does one deal with that? Then I want to give you a kind of second stream of examples, because quite rightly, our moderator, Barbara, has said, what about the environment, since I happen to work for the United Nations Environment Programme? Well, for the past 18 months, we've been running a commission of inquiry looking at one thing, which is what are the role of central banks and financial regulators, stock exchanges, credit rating agencies, and accounting bodies in driving environmental and inclusive characteristics into their rules and operations. We've looked in China, Brazil, India, South Africa, Kenya, Indonesia, and elsewhere. And we've also looked in a number of developed countries, the UK, the US, Switzerland, and elsewhere, just to illustrate the point. What have we found? Well, we found something quite curious, although actually it may not be curious to you. We found that whereas obviously the larger financial and capital markets, far more integrated, far more sophisticated, are in the north, the most interesting examples and important innovations that are happening in bringing environment and financial inclusion into the way in which financial markets are developing is in the south. It's in Kenya if you're interested in financial inclusion, or indeed in Bangladesh as well. It's the China Banking Regulatory Commission that's driven green credit guidelines that have now been emulated in Nigeria, in Indonesia, and elsewhere. It's the Johannesburg Stock Exchange and the Brazilian Stock Exchange that have brought sustainability listing requirements into force, and other countries, including, for example, NASDAQ here in New York, the London Stock Exchange, have followed suit. Actually, we have a very interesting situation where everybody's looking at the development of financial capital markets at an aggregate level in the major markets, but some of the most interesting developmental progression is being made by central banks, financial regulators, and other actors in developing countries. That's kind of interesting. So you have one level of integration that's problematic, which is the integration to international standards and processes that create problems for you, and you have another set of factors that are driving into some of your markets, led by your central banks and financial regulators, that actually are really innovative and could be really effective if adopted elsewhere in the world. I could give Barbara a whole lot more examples, but I just really wanted to sort of draw it in at that point, and perhaps we have time for a little conversation. Obviously, my message is not don't integrate markets. That would be a completely absurd thing to say. But my message is, first of all, not every integration is a good thing, and many levels of international integration are a problem. And secondly, that there are many innovations happening in Africa and other parts of the developing world that are taking central banks and financial regulators into the development process in a way that the Fed, that the Bank of England, that the Bundesbank, the Bank of Japan, and the European Central Bank wouldn't dream to do in 100 years. And we should understand that and really encourage those developments elsewhere. Thank you.
I'd just like to say that I agree with my colleague 100% on those aspects, because another example of a model that we should be looking at is Grameen Bank in Bangladesh, which has gone down level, at each individual level, serving the women, serving the populace, which is completely unbanked, So there are very good models like those around the world that, we should be trying to integrate as well.
Yeah, Simon, I think what you're saying is metaphysical even, because if you look at it, it's not only in the financial world, but it's also in technology. It's, we've turned upside down and inside out. And so I think there's a systemic need to think through, how do we identify sources of innovation in different locations and be able to disseminate them to create more of a marketplace. And in fact, at Addis, the side event we put together with Gates and the Swedish government and the Mexican government had innovation labs in developing countries for that reason. And with regard to financial engineering, how can we think of new financial instruments where local pension funds can provide contingency backup facilities that in effect, de facto, increase the tenors? And if you're interested in that stuff, we're working on it. But Simon, I think we should find out, can we have your study? Can we disseminate that? I mean, this is terrific stuff.
So just one more example, and I'm sure there are people in the room that know this example better than I do. We know that Kenya has the highest penetration of cell-based payment services in the world today. And we know that that was enabled without being disrespectful towards the Kenyan banking community, despite what they wanted to begin with, because they were fearful of disruption to their own business models and profit margins. But as time has gone on, the Kenyan banking community has got on board and has kind of seen the opportunity. Whereas in South Africa, for example, far more resistance by the banking community, the ability to mobilize the regulator to prevent non-banking entities from using cell-based platforms, and actually a much lower level of escalation of financial inclusion using mobile-based systems. Now, what's interesting is that in the Kenya case, it all started off as simple payment models, but it's evolving, from M-Pesa to M-Kopa, for those of you from Kenya or who know the case in point. So today, Kenya has the highest opportunity to build distributed renewable energy systems, in part because owners of renewable energy technology don't need credit records of poor people, because they can run a pay-as-you-earn system through a mobile payment system. And that is in part because of technology, but actually the real story is not technology. Everybody's got the technology, and everybody can do payment systems. The real story is about the willingness of Kenya, partly eventually the banking community, certainly the Central Bank of Kenya and several other players, to allow a level of disruption, to allow a technology to enter the banking community, to challenge the banking community in many ways, to kind of wake up and shake up and start doing stuff differently. And then actually that has evolved into an interconnectivity with another source of technological innovation, which is renewable energy, or in this case, distributed renewable energy. These are the areas that we should be really excited by. It doesn't mean that the basics of integration is not important. Please don't misunderstand what I'm saying. But it does mean that there are some very interesting processes in play that, frankly, Barbara, despite your example from Addis, and I do take your point, actually doesn't involve the development community and doesn't necessarily involve development banks and doesn't necessarily involve concessionary financing. And actually, most of the time, doesn't involve any of that stuff at all. For those of you who listened to Carlos Lopez, this afternoon or this morning, that's his story. It's not that development aid is bad, but actually it's disruptive in problematic ways at times and stalls the types of innovations that often can and need to happen. And I think in the financial community, the irony, just like with mobile banking, is that in many developed countries, the banking community is now, shall we say, quite strong and is quite resistant to change. But in Africa, actually, we just have the beginnings of the development of a banking community and its relationship to capital markets and new technological opportunities, and the potential for leapfrogging in financial services is really there. Thank you.
Well, isn't that provocative? We're supposed to move on, but I wonder if we want to take, elevator speech like we did for the other, but in response. Should we just go down and make some final comments?
Yes, we want to go to the audience.
You want to go to the audience?
Sure.
Okay, let's do it very quickly. Okay, please. Please reintroduce yourself, and the mic is there. Thank you.
Ahmed Diomande from Côte d'Ivoire's investment promotion agencies. I think this was incredible to hear Mr. Simons?
Simon.
Yes, because after your predecessor, I thought, what is UBA doing in Africa? I think we can sit here and talk all night long, and we'll never get to any point unless we really understand what is happening in Africa. Part of the conversation here is that Africans themselves are not telling you what they need. And you have to bring that into the conversation. We talk about the capital market. I live in Côte d'Ivoire now for about a year and so. Coming from America, I was flabbergasted when I saw how the cell phone business, what it is doing in Africa. Yeah. So we cannot, I know, Barbara, right? You talk about the toolbox, that we have all the tools. I don't think we do. I think we really have, as they say, think the way we changed, we look at things. I believe small businesses, we haven't talked about small businesses. I heard the previous panel talk about investment, lack of, illiquid equity markets. But where are the small businesses that are really driving this whole engine? They can't get a new loan. We currently, in Côte d'Ivoire, we have experienced a small startup program. And those startups, one of them right now has a technology where you would have a computer that comes with internet integrated. We haven't even talked about that officially yet. So my point is you have some brilliant mind, but we can, if we still look into the old book in trying to find solutions, no, it hasn't been written yet. So I really think we have to challenge ourselves in looking at how we can change the model. There's the leapfrogging ability in Africa, and unless we understand that, we will not get anywhere.
Thank you.
Yeah. Does anyone want to comment? I totally agree. Tass.
No, I think that goes to Simon's point as well.
I think I don't have to introduce myself. You know me. I'm actually very surprised, as I was always surprised on the last 7.5 years. I listen to presidents, all of them I know in person, and we are here for Africa for investments. I didn't hear any good story today, and I was sad. I know that myself, I invested on behalf of African Development Bank in 49 infrastructure projects. They are all success stories. And all of them, actually, the return for the investors is, for the lender's model, 19%. For the investor's model, 22 to 23%. Nobody talk about this. There are huge success stories. You are from Ivory Coast. We did the first toll bridge in Africa. It's very successful. It was actually completed on time, on budget, 6 months ahead of the time. So why we are not talking about this? All of the presidents here, they would have told the public today what is the return these people are going to get? And here, the question to the presidents was actually how we are going to integrate the countries and so we can come and invest in your countries. Actually, we don't have to wait for anything. We should just go and invest. 5 years later, it's going to be too late. And I don't know why we are not marketing ourselves in a different way. Simon talked about, sometimes development banks are becoming a challenge for growth. I come from one of them. And I remember that first time when I took a coal power plant to the board, it took hell of a time for me to convince 84 board members. But as a country, Senegal, no hydropower resources, no gas. So what you gonna do? You are going to let people in dark because it's coal power plant? So I think we should really start marketing ourselves in a different way. I just wanted to say this today. I mean, I am a little sad again. In New York, we are not marketing ourselves enough.
Can I add a
Catherine,
comment?
are you saying we need to, I'm really sorry, but I'm being told.
Real quick thing on that.
Okay.
And part of it is I think you really have the business community that I come out of is much more mature, the business leadership, than the political leadership is. I mean, the fact is, business is the one that's going to be out there doing more of the selling and the pushing, and probably need less of the political leadership to, start coming up forward with us. That's the answer.
Okay, so I would like to thank all of these gems that we have in front of us again, truth to power. How do we communicate it better? So please join me in thanking our panelists.
Doing business in Africa. You can't afford to be without Africa Investor.